firm just over 10 months now, and I work in Utah's branch as a paraplanner, and I will be today's moderator for this webinar. I am joined by David Daughtry, Jake Eggett, and Karina Olson, and they will be the presenters for today. This webinar is being recorded and will be available on our website within the next couple of days. And if anybody wants a copy of the deck, don't hesitate to reach out and we will go ahead and provide that to you. We will be having about 30 to 40 minutes of planned remarks, and then we'll have a Q&A session at the end. So at the bottom of your screen, you'll be able to see a place to enter your questions. Go ahead and do that, and we will try our best to get to them at the end. So with that being said, I'm going to go ahead and share my screen now. Start off with a question here that, is likely to be on everybody's minds is the election is now over. Now what? So I'll hand it off to David for that.
A great question. After all of the volatility and back and forth and what does it mean? And we've had what if scenarios for the last, seems like 2 years from an economic standpoint. Let's talk a little bit about what's top of mind now that the election is over and we know who's going to be president, we know who's going to control Congress. How does that impact what's going to happen in the economy and therefore what's going to happen in the market in your portfolios? So the first thing is the impact on taxes. I mean, that has been something that we've been talking about for really the last 2 years, because on taxes, especially for households and individuals, the tax rates were set, they are set, if you go to the next slide, to sunset and then go in the end of next year, so a little over 12 months from now, and that they would all across the board go up from 12 to 15 all the way to the 37 up to the 39.6. If Congress is able to pass, which you would think that they would be with President Trump behind it, an extension of the TCJA tax changes, then we will stay in our current regime of 12 to 37%. And that will be beneficial because, excuse me, because you'll have a little bit more money in your pocket. Now, be beneficial for all the individuals, not so much for the federal government as far as their budget deficit and debt. And we'll talk a little bit about that later on. The other place where it will come into play, not so much the sunset, because the sunset provision did not affect corporate taxes. They were passed as a permanent tax bill. The ones for individuals was not. And so if you remember back in 2017-18, before that, it was 35% was the corporate tax rate and was dropped all the way to 21%. So that had the effect of increasing the earnings per share and the reported earnings, because you take, my gross profit and then I have to take out taxes to get my net. Well, President Trump is talking about lowering that to 15%. Now, this chart, if you look, the sort of orange line that's straight and drops down and goes up a little bit occasionally, that's the official tax rate. The blue is the effective corporate tax rate, meaning what are they actually paying? And you say, well, shouldn't those be the same? Well, they're not, because there's various tax loopholes, tax strategies and stuff that corporations can do. And so when it was 35, they were not paying 35. Most of them were not. And even at the 21, you can see most of them are not paying 21. Will it be lowered to 15? Probably not 15, but maybe 18 or 19, maybe 20. So any lowering of that will have the effect of increasing earnings per share across the spectrum of corporations. So that will be a benefit to corporations, not so much a benefit as far as the deficits. So now the other thing that we've heard a lot about is tariffs. And we thought it might be helpful here to just show how tariffs work. And so the example we have is very simple. Socks made in the US costing $3. Socks made in the UK costing $3. And then having a tariff. If it was $1 tariff, then socks in the US all of a sudden would be $4, not in the US that were made in the UK would be $4. What usually happens is that the US made stocks, you would think, oh, they're going to sell a ton more. Usually they don't. What they do is they raise the price and just make more money as far as profit. The other thing is you've probably heard that China's going to pay and Mexico's going to pay and Europe's going to pay. The countries don't pay at all. The tariffs are levied on whoever imports that. So the distributor that imports the socks from the UK is a US entity that pays the tax, and they pass it on to their end buyers, which usually are consumers. So this works really well if you've got somebody that is unfairly, selling something below market price in the US, to get them to negotiate on unfair trade practices. But if you added 20% to everything that we import, it's just going to increase inflation. That's what it's going to do. So I suspect it'll be used to really negotiate with countries that are not being fair on trade, but it won't work very well as far as generating a lot of income, because if it does, that typically hurts the U.S. economy. So we'll see how that plays out. A lot of the stuff you hear on the political trail, campaign trail, it doesn't really pan out. I mean, it's all about getting votes, not doing stuff. The other thing on tariffs that really has a big impact is foreign revenue from companies that are based here in the U.S. Because if we levy a tariff on China or European countries or South American countries, we not only import from them, but we also export trillions of dollars. In fact, if you look, the Russell 2000, which is the small companies in the US, 24% of their revenue comes from outside the US. They're exporting stuff, and that would be impacted. If you look at the S&P 500 overall, it's 41%. And if you look at just the tech companies, which have done so well the last 15 years, there are even higher revenue outside the US. So it's a delicate balancing act where you're trying to get free trade, fair trade, but also not being so protectionist that you kill the sales to foreign countries. So we'll have to see how that turns out, but that could be a challenge. If we do get in trade wars in multiple fronts, that probably hurts both the U.S. economy and probably the stock market.
Dave, one thing that you've mentioned lots of times is the benefit that we've gotten from China over the last 30 years has just been lower inflation, right? Even though
we've imported low inflation from China and given them jobs, basically, because they wanted jobs and they were willing to work for less. And so, we got cheaper things from China. And there's still some areas, you're seeing Vietnam and Philippines, sort of the same thing taking over. The other problem that you have with tariffs is a lot of times it just changes. It doesn't change where it's made. What changes is where it shows it's made. In 2018 and 19, when there were some tariffs put on China, some pretty hefty tariffs, all that happened is stuff was still made in China, exported to Indonesia or Vietnam or the Philippines, repackaged with made in Vietnam, and then sent to us. And it didn't change anything at all, really. So we got to be careful on that. And like I said, lots of things that are said on the campaign trail are just that, campaign trail. It's get people to like you, get people to agree, and then the reality sets of some of the things that you can't do, and there's nearly always some compromises. So the other thing that we're seeing post-election is in the regulatory arena. Deregulation or even not deregulation, just less of more regulation can help various industries. For example, the day after the election, financials, JP Morgan, Bank of America, Wells Fargo, Citi, all banks jumped dramatically. And I'm talking about some of them 10, 12%. And you say, well, why would the election help them so much? Because there were I think it was the Consumer Protection Agency was talking about and had proposed limiting the late fees to like $9 or $10, where they're typically multiples of that on all banks and credit unions and mortgage companies and stuff. And so that probably doesn't go through. And so that's a pretty good percentage of pure profit for the financials. On the energy side, there will probably be more liquid natural gas, LNG facilities that are approved. Now that'll take years to actually get them up and running. The drill baby drill idea sounds great, but we've already been drilling a tremendous amount. We're at all-time highs on gas production, oil production in the U.S., never been higher. But what it will do is it will probably open up some energy areas that have been closed, but also make it faster to get to drill, make it faster and less costly to do pipelines to get what we've drilled where we need it to be. And same thing on utilities. There'll probably be less regulation on coal or less increased regulation on coal. There'll probably be an easier method to get approval to restart some of the nuclear facilities, and also get approval quicker to do some of the modular nuclear facilities that have been proposed that could dramatically reduce the cost of building a nuclear power plant. I mean, nuclear power plants have been, infamous for huge cost overruns. Not, oh, it's going to cost us 10 billion, it costs us 12. I'm talking about it was supposed to cost 6 and it cost 20 billion because they take so long. And a lot of that is the regulatory side of it, because every facility out there has been specific to that, that location, and it's all custom. And the new ones that they're proposing are modular. You make most of it in a factory, you ship it out, you put it together, and it'll cost you a whole lot less. So I think those industries probably will benefit. There'll probably be some industries we don't even know that will benefit from deregulation, and some that will think deregulation and may not end up having deregulation. Because some can be done at the presidential level, some can be done, in conjunction with Congress, and nearly anything that's done is going to go to the courts, and sometimes it can take years and years and years to get through the courts. The other considerations that we are looking at is on the international relations side. If Trump can get a settlement in the Ukraine, that might lower oil prices, because all of a sudden you'd see the Russian oil back on the market, unfettered. Immigration is sort of a mixed bag. I don't think that you're going to see less coming across the border, some that are here that will get deported. But the reality is the numbers are all over the board of how many illegal immigrants we have, all the way from 5 million to 25 million. The reality is you don't know where they are, you don't know what they're doing, and you don't have the manpower to remove them all. If you removed 5 to 20 million people that were in America consuming and working, it would be an economic disaster. So the best thing is probably if they can get the criminals out and close, at least limit the border immigration, and figure out an immigration policy that nobody for 40 years has been able to do, which hopefully they will. Then we'll see. But immigration has actually been helpful from basically allowing the short-term problems that we have on nobody being able to find enough people to work in the last few years. That's sort of gone by the wayside. I mean, yeah, there's still people looking for jobs that can't find them, but most of those have other issues. I mean, we're at a very low unemployment rate. So a lot of different issues there, and there's probably some that we don't even know right now will be impacted. So let's go ahead and look at where we're at and in the economy and what's the Fed doing. I mean, it seemed like for the last 3 years, absolutely, we've been talking about the Fed, and really nearly for the last 20 years, it seems like. So, Karina, why don't you jump into that?
Yeah, thanks, David. And you're right. And a lot of these slides you'll see we've had in our webinars over the past couple of years. We just keep updating them because it's still important to look at the same data we've been looking at. When we think of the economy, the first thing here is GDP. And so you've seen this chart before with the orange bars, and this one we've expanded it a little bit. It goes back to Q4 of 2020. So you can see this post-COVID, right, coming out of 2020 into 2021, we see those larger bars, higher GDP. 2022, we did have that dip. If you remember, a big part of this was the supply chain issues we were facing as well. There was all the ships off the harbors, especially in Long Beach, that weren't able to come in. And so we have that kind of anomaly there in the COVID world, the supply chains. But looking towards the second half of the chart here, 23 and 24 especially, this is where we are now, right? In 24, the Q3, the third quarter numbers came in not long ago, and they were solid. They were slightly disappointing because the expectations were 3.1%, but it was 2.8%, which means our economy is still growing. The two really big drivers on this is consumer spending, which makes up about 2/3 of all activity. And that means that we're all out there spending money still, right? Going out to eat, traveling, whatever it is, buying the goods that you need. So that's driving it. The other piece is the other end of the spending, which is government spending. I'll talk a little bit more about that in a couple slides here we have on the debt and the deficit, but that is good to know, right? Consumers are spending, the government is spending, we're still seeing that positive economic growth. For the fourth quarter, right now, the GDP now is estimating a 2.5% for fourth quarter. If you haven't been in a meeting with David lately, you may not have heard this, but if you've heard him talk about his new favorite app is you can actually download, what is it, David? It's just called GDP Now. Right?
GDP Now from the Atlanta Fed.
You can download it on your phone and you can check every morning to see what the estimate is on the GDP.
Better than TikTok, man.
So that's where we got the number. Right now, expecting 2.5, so a little lower than the third quarter, but still a nice, again, just solid GDP economic growth there is what we're seeing. So that's one of the data points that the Fed looks at. If you go to the next slide, Aaron, we'll actually see the big question. What's the Fed doing? So last week, actually right after the election, the Fed did have their scheduled meeting and they did cut rates again by 0.25%. So this chart here on the screen, we've seen this in different variations before. This is called the Fed dot plot. Each blue dot on there represents one of the committee members and their vote on where they think the federal funds rates will go over the long run here. So starting with year end 2024 all the way out to 2027. You can see we've highlighted with the green boxes kind of just where that average is, right? Where a majority of the Fed members thinking it's going to go. And then the arrows indicate those cuts that we see. In the short term, you can see a lot more of the dots are bunched together. So ending this year between 4.25% to 4.5%. What that would mean is that there is actually one more rate cut coming. The Fed meets one last time in December. I think it's December 17th, 18th. And right now the market is estimating that they will cut again by 0.25%. That was actually even solidified a bit more this morning. So going into today, it was about a 60% chance that the Fed would cut. But after the CPI, the inflation numbers came out earlier today, the market is now baking in an 80% chance that they cut by 1/4%. If you haven't seen it yet, we don't have a chart on it since it did come out this morning, but the CPI for last month, year over year in October, was 2.6%. It's a slight increase from the 2.4 we saw in September, but it did match economic expectations here. And so right now, what we're hearing from the Minneapolis Federal Reserve Bank president is that just based on this, he's confident inflation is headed down and that we're still on that downward path right now. The other thing I'd point out about this, though, so that's the short-term rates we're seeing. But when you go out to 26, 27, you can see that those blue dots are getting more spread out, right? There is that one dot saying, no, it's going to stay at the 4%. When we were talking earlier, I was wondering, is that the same person who says, nope, it's just going to be 4% for the next 3 years here? We'll never know. But with that, you can see there is less of a chance. And I think the kind of takeaway from this is with the data we're seeing, with the remarks from the Fed, with the dot plot, is we are in agreement that we are in this downward path right now of lowering rates. I wouldn't be surprised, though, that the projections for 26 and 27 just continue to change as they get closer there. So that's just something to keep in mind. And the other big thing with this is that the Fed has control over the short-term rates. Something we've started to see, though, is that that's not necessarily impacting long-term rates. So this chart here, the kind of brownish copper line, if you would call it that, that's the short-term rates. We're using the 3-month Treasury rate here to indicate what that is. And that's when we say Fed's cutting rates, that's impacted more. This is your Treasury bills, your money market, your high yield savings accounts. That's where you're seeing those rates come down pretty lockstep. The blue line here, that actually represents the 10-year Treasury. So this is the longer term. Think mortgage rates too are impacted by this. You can see this goes back to 2022. So you see the big run up in the short-term rates when the Fed started raising rates. You see it kind of level off there throughout the last year in the summer. And then you see it starting to come down when they started to lower it. But at the same time, you see the 10-year starting to come up. And there's really two things that's impacting that. One of them is the deficit. And we'll talk about that too, is ultimately, I mean, we're 35 trillion in debt right now. And so that's impacting it, right? Our spending, how much we're spending, how much we're bringing in, and how much the government has to borrow. So I'll talk more about the debt and the deficit there. I think the big thing to keep in mind with this, because we hear this often as well, when will mortgage rates come down? And that's the hard part, is if the 10-year Treasury is still staying high and going up and not coming down, that's where we're going to see the mortgage rates stay pretty consistent there with the 10-year rather than come down as that 3-year comes down.
And, Karina, one of the things that, we've been looking at, hey, the trajectory is down, but nobody, and maybe they're wrong, but nobody is saying, oh, we're going to get back to 2% or 3% mortgage rates, or we're going to get back to a 0 Fed funds rate. Nobody is saying that. They're saying we're going to be more normal than we have been in 15 years, that your money markets will be 2 to 3%, not 0, and that mortgage rates are probably 5 to 7%, not 2 and 3, because what we had during that time frame was not normal. It went on for so long that everybody thinks it's normal, but most people that are listening on here, they've lived long enough to see that 6, 7, 8% mortgage rates are not, out of the normal. That's historically the last 50 years been a pretty decent rate.
And generally, would you say this day, economically, if you have a 2 to 3% Fed funds rate and a 4 to 5% 10-year Treasury, that's actually, a positive for the economy.
It is, but because especially, savers since 2008 have been penalized by the Fed pushing rates very low, because historically, if you just say, I'm going to take no risk, I'm going to do Fed funds or T-bills or money market, I could at least always make the inflation rate. And yet for 15 years, it was below that. And so now it's getting back to the more normal thing. Also, that it's, if I go out 10 years, I'm going to get paid a lot more than if I go out 3 months. So I do think rates are coming down. They probably come down slower than the market. The market's been wrong on the way up. You know, how quickly they would go up, how far they would go up. They've been wrong on the way down. And for our fixed income total return piece, you know, it being higher longer is actually very helpful because we haven't seen these kind of yields for, you know, 17 years, something like that.
Karina, maybe one other thing to add. I mean, I can't tell you how many people that I'd talked to or heard about where they're like, "Oh, I'm gonna buy a home or you know, lock in the interest rate I want for my mortgage after the Fed starts cutting rates." And it's interesting to see the longer end start to move higher in this
Yep.
case. What's besides the deficit that you mentioned, and what's the other reason, Karina, that you'd say that long-term rates are moving higher when short-term rates are coming down?
Yeah, the other thing is really that the Federal Reserve is still draining liquidity. And that's the other piece that's less popular to look at, I'd say, right? Because the Fed really has two things it can do. It can lower rates and raise rates, which we've seen, right? Raise rates, lower it. The other part is the balance sheet. And this is it doesn't make the headlines quite as often, but it is important to know that the Fed is still draining liquidity on the balance sheet here. And that's what you can see on this chart is you see over on the right-hand side that it continues to go down, which means they're pulling money out of the system here with it. And that's just a drag on the financial markets. And if you saw Powell's last remarks last week after he met, he did remind us that it's still monetary policy is still restrictive right now. And that's one of the ways they're doing it is by sucking that liquidity out, that money out there. It's going to ultimately impact those current 10-year, the treasury rates that are still out there are going to remain high at this point in time. So with the Fed, ultimately, kind of what we're seeing before I talk about the deficits debt here is, you know, we still do believe we're in this environment right now where the Fed is going to continue to lower rates. To David's point is the market's kind of been wrong. The way up, the way down, it might not be as fast as we want. And the thing we're keeping an eye on too is how does the 10-year react to this? And I wouldn't expect the 10-year rates, you know, don't have the expectation that mortgage rates are coming down just because the Fed's lowering rates there. But too, when we look at the economy, going back to that GDP slide, ultimately, right? Consumers are spending money. We didn't have a slide here on the employment rate too, but unemployment's still low. And so we still are, our favorite phrase, right? You've heard us say it before, cautiously optimistic, right? When we take that zoom out. The thing we are keeping a close eye on that is a bit concerning though is this, the deficits and the debt. So I'll talk about both. So the first one's the deficit. And remember, deficit is the annual difference between spending and revenue. And so this chart here goes back to 2000, and the orange bars represent what our deficit was, right? The US budget deficit. And for this year, for 2024, it's 1.83 trillion is what we're looking at. To kind of break that down, what that means is the revenue was just shy of 5 trillion, but our spending was 6.75 trillion. So at the end of the day, we made the money and we spent more by 1.3 trillion than what we brought in. And that's where we end up with that deficit. Earlier, right before this, Jake and I were looking, it's called usdebtclock.org, Jake, right?
Yeah.
If you go to it and look it up, it is a constantly updating, ticking. It has lots of colors and boxes on it, but you can actually see the debt in real time on what's happening.
I was joking around. I said it would be funny if it just clipped over, you know, from 35 trillion to 36 trillion during our call because it's moving up that fast. So
Yeah.
I didn't think that'd be that cool. We don't want it to go up that high.
It's a depressing website when you
Yes. So that's the deficit there that we're running. And then if you take that big picture, right, is each year, you can see each year we've been running a deficit there since 2000. And so it just keeps adding on to itself. And that's where we get our debt, the total outstanding debt in trillions of dollars. This chart goes way back to the 1800 here. And what you can see is it took 221 years for the US debt to reach 12 trillion. And then you see this sudden spike up, and the US added 12 trillion in debt since 2020. So just really putting this in perspective of the history versus what's happening in real time here in trillions of dollars. When we look at these numbers, when you look at the usdebtclock.org, I think it's really hard to figure out like trillions of dollars. What does that actually mean? What is it that we're doing? So we actually found this really cool chart that breaks it down into more of a, if this was your household, how you'd be managing it. So this is the US budget versus just a family budget. So if you take the median family income in the US is $74,580. And that family spent $103,058 in a year, which means they'd have to put a little over $28,000 on their credit card, despite already being $573,000 in credit card debt here. And so you see this problem of, if you continue to just always spend more than what you're making, it just keeps adding up. And when David and I were looking at this and talking through it, this isn't you guys all see it, just cut your Starbucks out daily, right? This isn't a cut your $5 latte out or, fill in the blank for whatever it is. This is big changes that need to happen. If this was a client who sat down with us, this would be, you need to downsize your home. You need to find a new job, make more money, right? There's big moves that need to be done. And so if you think about it that way with the government, it's the same concept of this isn't small things to fix this, but big decisions that need to be made. And just at this time, we haven't seen from either side really a plan to address that, right? On what to do. Because really, again, it's you either you make more or you spend less. Going back earlier to David's talk on the tax piece of it too, that's a big part, right? A big part of our income comes from taxes as a country too. And so tax cuts it creates less revenue coming in. So if we cut taxes, we got to figure out how are we spending less money on the other side of it here. So that is something that is the big question mark, kind of concerning, right? Again, we're still cautiously optimistic, but that is the debt and the deficit and just the fact that there's really not clear plan moving forward on how to address it is something that's top of mind for us that we will continue to look at and bring up in these webinars here. I think with that being said, though, on the election and the economy, I'm going to pass it over to Jake on what are we currently doing and do we anticipate changes in the Copperwind portfolios?
Yeah, thanks, Karina. The thing I'm most excited about with the election being done is I get a whole lot less text messages and email spam calls. That's been...
It's crazy how fast they just dropped off. Nothing anymore.
Yeah,
it's
I've
wonderful.
become a lot less popular after. People were calling, texting, and I felt really special. And now I get nothing.
You are special, Dave. So... But yeah, let's talk a little bit about the market this year. It's actually been a very strong year among most asset classes. We have this graph, this bar chart here of just the S&P, the NASDAQ, small companies, and a couple of international markets. And it's been a positive year all around. There's few asset classes that are even negative this year. But the trend continues to persist. When you look at the S&P and the NASDAQ, US-based companies that are large in size, it's just been a tremendous year. 27, 26%. That is a big year. Small companies have really rallied since the election results. When we talked about potentially lower taxes, lower regulation, and some of these things, that's really benefited small companies. We've seen small companies since the election probably go up nearly 8%, where large companies have gone up maybe 5%. And then on the flip side, you've seen international companies deteriorate here. You've seen, a 2 to 3% decline on some of the international stuff, whether it's developed or emerging markets. And part of that is due to a stronger dollar and then some of the trade discussions that David was talking about earlier.
Jake, on where we talked about the percentage of foreign revenue, if the tariffs come in, small companies, like I said, they generally will raise prices, they make more, and more of their revenue comes from domestic. And so it makes sense. And, the international ones, if they're exporting to the US and there's tariffs, it's going to hurt them.
Yeah.
I think the other thing with the small companies too is that the Fed continues to lower the rates for borrowing money because typically it's the small companies who need to borrow more. And so we saw them really get impacted when rates were higher
Yep.
of the cost to borrow. And so I think kind of twofold here, David, with that too, is if it's cheaper to borrow and they can also increase prices, that could be a positive for them.
Yep.
Yeah, and a lot of people ask, is this a really bullish game changer, with Trump getting in and what we've seen over the past few days? I mean, markets are forward looking, right? And so they're trying to price in, the potential future, and you're going to continue to see that happen. I don't know that it's necessarily a huge bullish game changer. I think when we look at some of the stretch valuations, I think that's one of the concerns. I think as we go into year end, though, historically, November and December have been very positive months historically. So barring any major surprises, this could help us, get into the end of the year.
Okay, I think this initial bounce, I mean, 5% on the S&P and 8 or 9% on small cap. I think this election was so divisive that on both sides of the aisle, there were investors that said, well, if the other guy, the other person gets elected, it's going to be a disaster. So they parked money on the sidelines. And so I think now that that's over, I think some of that money's coming back into the market. The question is, how much of it, and is it going to be a steady flow for the next few months, or did we get most of it quickly? I don't know.
Yeah,
time will tell.
I think that's a good point. But there's, I would say, going back to some of the trends, I mean, that's something we follow very closely. I mean, we've seen gold, for example, has had a really good year. After the election, it's probably dropped 5% or so, so some of these trends that we pay attention to, sometimes it's just a very short trend and then it kind of turns around. But so far, we've continued to see U.S. companies do well, and mostly on the large cap side. And you'll see that in our portfolios now, kind of to what we're doing. This is one particular strategy we like to focus on. It's kind of the core building blocks to our clients' portfolios. It's called our core equity strategy. And what you see here is a couple of, 9 different circles, right? The top row of circles is representing large companies. In the middle there is mid-sized companies, and the bottom row is representing small. And then growth companies are on the right side, value companies are on the left side. And historically, I would say we've had a fairly decent tilt to growth companies. And we've predominantly stayed large cap just because the trend has been there. I would say one thing that has shifted over the past several months is we've moved certainly more to what I'd call a blend, or more in the middle of the road here. We've maintained our exposure to large companies. If this trend with small cap continues, you might see us pick up a little bit more there. But so far, this is how we've seen the portfolios adapt to the changing trends. Okay.
And with no international emerging markets, because they just haven't performed.
Yeah, had no international. I would say the one other thing to maybe represent here is this particular strategy, takes a tactical approach, and we'll do one of two things. It will either, be in the market or not in the market for a portion of the portfolio. And we've stayed fully invested through most of the year just because the trends have been very strong. So as we move from stocks, let's shift a little bit to bonds. We talk about the trend being your friend. It's been a mixed year for bonds. One of the key indexes that we focus on is the aggregate bond index. It's just a very broad-based bond index that we can use to track the general bond market. Earlier in the year, actually just a few months ago in September, October, it was up about 5%. And then you started seeing, as Karina mentioned, long-term rates moving higher, and that's pushed the price of those bonds down. So where it was up 5% or so, now it's only up 2% and might even be below 2% today. But it's been getting hurt because rates have been moving higher on the long end. What we've tended to focus on is predominantly these other two asset classes, high yield corporates and bank loans, and I'll show you that here in a minute. But the trends of those throughout the year have been fairly steady, especially bank loans. They don't have quite as much interest rate risk. Both high yield corporates and bank loans have a fair amount of credit risk, but their trends have been positive and upward sloping. So we've mainly been able to stay in those. And as we look at kind of how we're allocated, I should maybe say this, that if we look at the yields, Karina mentioned how short-term rates are coming down. So on the far left-hand side, you can see the 1 to 3 Treasury bill rates. Those had been earning over 5, about 5.4% earlier in the year. Now they've moved down to about 4.5 to 4.6. We continue to expect those to kind of come down as the Fed lowers rates. And if you look at the asset classes that are in blue, these are some of the things that we're typically in. And we're still seeing yields of anywhere between 6, 7, and in some cases still 8% on some of the bank loans. So we've been favoring these, and mainly because the yields have been good, and the volatility has been low. So as you look at how we've allocated the portfolio, we focused on about 60% in bank loans still. That continues to be the place that we want to overweight our clients' money. We have about a 20% exposure to junk bonds. And then we do have another 20% sleeve of what we call strategic income, which actually gets into some mortgage-backed securities and some other asset-backed securities. And we've been very pleased with that portion of the portfolio as well. So,
Jake, if you look, one of the things that the total return income strategy this year has really, done very, very well, especially relative where you were showing the aggregate bond index that's up slightly more than 2. In fact, I think if you look at today, you're below 2, and we're between 5 and 6% as far as the total return. So it's been a great year in bonds, and hopefully, if rates don't go down too much, we're going to continue to have some really good yields, dramatically higher than we've had for the last 15 years.
Yeah, I was also going to add there too. I think important to know, as you saw with the trend is your friend slide there, is we've been able to stay in the floating rate bank loans the entire year. And high yield, there was a bit of a blip in April where we did move out, but other than that, we've been in since then. And so it's been nice to be able to stay in, collect the dividends. And if you have this in your portfolios too, knowing that we will still have dividends at the end of this month and the end of December coming in as well.
Yeah.
Yeah, and the higher yields, as David mentioned, has really helped clients' portfolios. Expect to see dividends and interest be, a bit higher than they've been over the last several years, just because the rates have come up. So
you get to pay more taxes in April.
Yeah, you make more money, you get to pay a little bit more. That's definitely the case.
We gotta help pay down that deficit.
So I think one other thing is we look forward kind of to 2025. One of the concerns that we certainly have right now is valuations. This is just a chart showing the S&P, their forward price to earnings ratio. Historically, over time, when you look over the last 30 years or so, the average is about 16 times earnings. And right now we're at 21 times. And so you can see kind of where that price to earning ratio came in back in the tech bubble and in the year 2000 or so, or in the late 90s, it got up to 24. You saw it get up above 22 back in 2021. And so we're definitely on the higher end. And I would say this, it doesn't necessarily mean that, hey, market's going to fall. In fact, markets can run a really long time being overvalued. It's just one of those things to just be aware of and something we keep an eye on. And I think going into 2025 is something that could potentially cause, a pullback in the market if there's other things that kind of trigger that. So So David, any other things that you maybe want to touch on as we look into 2025, things that are on your mind?
No, I think the unknown stuff that we'll see from the geopolitical risks that we've had. If that settles down, I think you could see some market improvement there. But the valuations are always an issue. But as you can see, I mean, 1995, 96, you were you were at the average, and we had 3 or 4 years that were above average before it ever started to come back down. So it can stay up there for a while, and especially on the growth side and tech side, the earnings growth is quite substantial, and that is what you need to justify these kind of forward PE ratios.
Yeah, I would say maybe the other risks that are top of mind is we continue to watch the bond market and interest rates. I mean, as long-term interest rates, if those continue up, that's going to continue to put pressure on, a lot of ordinary bonds. And then I think how the trade wars kind of play out, I think will be another important factor for the coming years. So, those are some of the things on our mind. I think as we look into next year, I think let's talk about some things that are maybe a little bit more pressing, just year-end topics. Aaron, why don't you kind of walk us through a couple things that we've been thinking about here lately?
Yeah, thanks, Jake. Again, before we kind of think ahead to 2025, we got to make sure we take care of things for 2024. So a couple of things that we want to highlight here. It's the busy season, tax season is coming upon us, and there are some deadlines for things that we need to do. So highlighting a couple of things here, tax loss harvesting. We will go ahead and look at accounts, and we will take care of that. Nothing that anybody has to worry about there. As far as RMDs and QCDs, that's at the top of the list because that needs to be done. We're doing our best to reach out to everybody to make sure to get that done. If you haven't taken an RMD or you want to do a QCD and that hasn't been done yet, reach out to us. Again, we're trying our best to reach out to everybody. So team effort there. Other thing, especially charitable giving, if that's something that you want to do, to try to do it a little bit earlier. Just because Schwab has, it gets really busy at the end of the year and they have the best efforts, in the second half of December. So try to get that done as early as possible. That would be fantastic. And also wanted to take a chance to shout out to our operations team who has been working very hard to get all this stuff done. So if you have outstanding emails from them, I know there's some people who still need to sign some DocuSigns to get some Roth conversions done or other things like that. Look out for those. And if our office calls you, go ahead and answer their calls so they can help you get this stuff done. Anything else to add there?
No,
I think too, the only other thing is, if you're looking at this list and you don't know if you need to do an RMD or a Roth conversion, just call us, schedule an appointment with one of us, or it can be a quick phone call too. We'd be happy to look at your specific situation, especially when it comes to year-end tax planning.
Okay. Well, that takes us then to Q&A. So that's the end of our planned remarks. So I'll stop sharing my screen and go to some Q&A here.
So one of the questions that came in while we were talking about maybe when we're in the bond part of the portfolio, but how much of your portfolio would you recommend to be in cash as a percentage for retirees? So maybe just a quick comment. It totally depends, but in general, I mean, when we look at cash, typically we'd have any assets or any spending that you plan on having in the next year, can certainly be in cash or cash-like instruments. But given that interest rates are where they're at today, we're seeing it be much more valuable if you're looking for any type of time frame at all to be invested more in our bond portfolio, just because of the yields and the potential return that you can get. But typically cash will generally be, 2% of a portfolio or less historically. Anything else that you guys would add?
Yeah, I'd add, Jake, too. I think that the good thing to remember too is when it comes to cash and kind of your emergency fund too, is the general rule of thumb's been out there, 3 to 6 months worth of spending, or Jake, to your point, a year if you're in retirement, want to be a little more comfortable. That really doesn't shift between when you're working in retirement a whole lot either, because knowing that, especially with the models you guys are all in our portfolios, we're keeping an eye on it and we'll take risk off if the time is needed. So you don't want to keep too much cash on the sidelines if there's not that immediate need for it. Of course, though, there's always situational, right? Big purchases coming up, that's different. We'll talk with you one-on-one on that piece. So I would really look at it more so, what's your emergency fund that you need on hand? And then anything else, to Jake's point, of take advantage of it. What we may adjust is just your stock to bond allocation, right? That changes as you go through retirement, is how much risk are you taking altogether?
Maybe one other thing to add too is just, I mean, the beauty of interest rates being higher is you're still earning more, even on, money markets and treasury bills. So, from a risk perspective, it's nice to finally actually have that money earning something where a few years ago it wasn't earning anything. So.
Yeah, and I think most everyone who's listening today, we've talked with you about that, making sure you have a high yield savings or money market. But if you don't yet, right, check to see what your account's paying, and we can always recommend some options on where you can earn a little more.
Another question came in, or another question that we have is, I thought that you said the market doesn't care who the president is. If that's true, why did the markets rally after the election?
Well, I think what we've said is the market. There's no real correlation between who's the president and how the market does over the next 12 to 24 months after a presidential election. I think what you've seen here is just an initial reaction, and we saw it in 2016. In the middle of the night, the futures, when Trump was first, it came out, oh, he's won. The futures were down 1,000 points on the Dow, and then by the morning, all that had gone away. I think what you've seen here is just an initial of money that had been put aside on the sideline because they were fearful that Harris would get elected, and they were concerned about that. Now that they know Trump is in, that came in. I don't think it will be a material change from where the market was going or will go unless we start to see some big changes in tax policy and seeing what the tariff things does, because there is a serious risk. Now, it's not high probability, but there is a non-zero risk that we get into a tariff war and we go into a recession. I mean, you could easily end up in that scenario because 41% of the S&P's revenue is foreign revenue. So I think that initial reaction, is once that money gets deployed, I think it'll be more, what's the Fed doing? Where are we in the business cycle? What are corporate profits?
And I think, David, that's a good point with it too, because we've said for a while now too, is the market cares more of what the Fed's doing, at least statistically significant,
Yep.
right? When you zoom out and look, what's the market done over the long run? It's, what is the Fed doing? Are they raising rates or lowering rates? And historically speaking, when the Fed starts to lower rates, and it's not because we're in a recession. So like right now, Fed's lowering rates, but we're not currently in a recession. That has tended to be positive for the
Yep.
stock market. And the key word there, though, is that recession piece, right? Is if the Fed's lowering rates because we're in a recession, that's a different story. So when we zoom out, I think we all expected volatility during the month of November here, right? Leading to the election, post-election. But when you look at the long term, it is going to be much more driven by what's the Fed doing.
Yep.
I mean, at the end of the day, the market goes up by earnings growth over time, right? I mean, that's
Yep.
The biggest correlation. But I'd also say this, I mean, the Republican Party with Trump, and it's been more about, the agenda has been more pro-growth, right? And
Correct. And pro-business.
Tax cuts, if they come on the corporation side, if they, even on the, the personal side, that's, as David mentioned earlier, those have direct impacts to
corporate earnings.
to corporate
Yep.
earnings. So, yeah.
So to go off that, Jake, actually, another question is, if the new administration is going to extend the tax cuts or even lower taxes, should we then stop doing Roth conversions?
Yeah.
Right?
Yeah, Roth conversions, it's going to be an individual situation, right? So because it totally depends on where somebody is, what tax bracket they're currently in, expected tax rates in the future, what income changes. So that is definitely a one by one thing. I would say, not to jump around a little bit, but the other thing that we didn't really talk about is, that goes along with this Tax Cut and Job Act of potentially sunsetting is also the estate tax exemptions. That there's a lot of worry that, hey, those things are going to go back down. And I think the probability is a whole lot higher that those stay higher given, the current administration. So which all play a part, all of those things kind of play a part in looking at should somebody be doing Roth conversions, right?
Yep.
And how we're going to transfer wealth, onto the next generation and how it's going to set up for your future years as well.
And I think along with that, Jake, is as you said, it's an individual thing because what are your assumptions? If your assumptions are most of this, my retirement, I'm not going to need all of it and it's going to go to my kids when I die. If they're in really high tax brackets, probably does make sense to Roth. And so it's all about your assumptions. I mean, if you look at, if everybody is looking at your, debt clock, they're going to say, oh crap, tax rates have to go up dramatically to get out of this. And if you think tax rates are going to go up a bunch in the future, makes sense to do it here. But, it's all about your assumptions and where is the money ultimately going?
And it's a year by year thing too, right?
Yep.
We look at the end of every year. And so it doesn't need to be we might decide in 24 to do it, but maybe not 25, right? And that's why typically we do look come the end of third quarter, fourth quarter at doing this rather than earlier in the year. Because especially come next year, we won't have as much insight in the beginning of the year as we will towards the end on what's going to happen.
Yep.
So always good reminder to just revisit with us each fall to look to see if it makes sense.
Yep.
All right, last question here. If I bought a home last year, should I refinance now or should I wait?
Mm. Yeah, that's a tough one because it's what was Yogi Berra's thing? Forecasting is difficult, especially about the future. And when you look at that, will rates come down? Well, I'm absolutely certain that short-term rates are going to come down. But you need probably at least 1% reduction in the rate that you're going to get versus what you currently have to make it, make sense economically, because you're going to have to get a new title policy. You're going to have to get a, appraisal, all of those fees and stuff that you incur. You probably need at least 1%. And I'm not sure most people, right now probably don't have a 1% lower opportunity. And I do think over the next couple of years, rates will come down. They're not going to go to 2.5% or 3%, but maybe they go to 5, 5.5, that, 6, or below. If you're at 7 or more and you get 6 or below, probably go for it. But if you're at 6.5, 6 3/4, and you can get 6 1/4, it's not going to make sense. So, and how long are you going to stay in the house? If you look and say, well, my job, I may move closer to my kids or my job may change in the next few years, then refinancing a lot of times doesn't make sense because you can't spread that cost over a whole bunch of years.
It's higher mortgage rates have made it really difficult for a lot of new homeowners and
well, especially with the huge increase in prices of homes too.
Yeah.
So
all righty.
Do we any other questions that came through, or is that about it?
I think we're about up at the top of the hour. So
we got one more, if we have time for it. Just came through the chat. Really quickly, do we need to add duration to our portfolios to take advantage of the opportunity, negative convexity of mortgage-backed securities?
That could only come from a CFA candidate. And I don't know who besides Hobby is a CFA candidate, but I don't think it was one of our clients.
I don't think our clients are actually thinking about the negative convexity here, and we can take that one offline with Hobby.
Yeah. Yeah. We will next time we'll have, the actual mathematical calculation of that over time. So
Well, with that, we would like to thank everyone who came and attended this webinar. Thank you to our presenters, Jake, Karina, and David. And again, this webinar will be on our website shortly hereafter. And yeah, I hope you all have a great rest of your day.
Yeah. Thanks everyone for attending.
thanks.